Let's unpack all this with Devang Mehta, who joins us on the show this morning. Mr. Mehta, good morning. Thank you so much for your time. Pleasure having you here with us. Do unpack the reaction that you are seeing on markets, not just today, but also put yesterday into perspective. And tell us, how should investors really deal with the jitters and the flow of news coming from abroad?
Good morning. Thanks for having me on the show. Always a pleasure to be on News9. I think, yes, what we saw yesterday and today is that probably markets have become a little more matured, if I can put it that way. And I'm no way saying that there can't be a negative reaction to what has happened. But I think this is impending since April 2nd, if I'm not wrong. The first week of April, this all started. And from April to May to June to July, and now we are into August, almost 4 months of uncertainty, if you can put it, or 4 months of volatility in the, at least in the proceedings of the news rather than even stock prices. What we have seen is markets had a smart rally from mid of April, May, June, July is when markets sort of corrected and consolidated. I think what participants want right now from Indian markets is more clarity on earnings, more clarity on the commentaries going forward. Sentiment in India is good. Macros are, I think, superb. We can't argue about any macros, right from GDP to tax collection to manufacturing data to probably inflation heading lower to interest rates getting cut across the board. I think most of the situations are under control. Volatility is the only constant when you look at the global markets right now, because US are also making new highs, but you know that there also interest rates is a problem. Interest rates are not getting cut.
That's right.
The tariff tantrums are still lying. My sense, yes, markets from here on would consolidate for a bit, but I don't anticipate a larger correction on the end.
All right, no larger correction anticipated. I will come to certain sectors with you, but staying with the fundamentals that you were talking about, Mr. Mehta, I want to understand what is your view on the rate decision that the Indian MPC, the RBI's Monetary Policy Committee, should take next week, given the fact that there is this fear that tariffs are going to slow down growth in India. There is fear that there is overall going to be an impact on economic activity. Do you think it's time for RBI to go ahead, for the MPC to cut interest rates once again, to spur that impetus back in the economy in the wake of this uncertainty around tariffs?
See, honestly, if you ask me, the RBI has done its bit in the last few months,
Sure.
Cutting it ahead of times, doing a 50 bips cut, which was not anticipated in the last policy, making CRR cuts of 100 bips, of course, on a phase-wise basis. They also sort of done a lot of OMOs. So my sense, it's a good fusion where government is doing its capex. Last year, it was sort of a mixed year where capex had stalled, but now government is doing its capex. RBI has already done rate cuts. I think the street is right now going with a no rate cut. If I understand it right, the consensus says that there is not going to be a rate cut now because the RBI governor has been on record saying that I front-loaded it. But as you rightly said, there is a growth slowdown also anticipated probably in India after the tariff tantrums and all. There can be a surprise rate cut, but as I said, we are not factoring in the rate cut right now. If it comes, it would be a positive surprise for the street, which will again sort of unleash the spirits that the corporate sector wants. But I think RBI has done enough. And if it is not done, but the commentary is again very dovish, I think market will take it with a lot of big heart.
All right, Mr. Mehta, let's now talk about certain sectors which are feeling the pain this morning. And the biggest pain seems to be coming from the pharma sector because, of course, a large market in the US now becomes 25% more expensive, and potentially there could be fresh pharma-specific tariffs that could be announced. Remember, way back, maybe, around the time that the Liberation Day tariffs on 2nd April were announced, Donald Trump had said that the pharma sector could see tariffs like never seen before. And the pinch is really being felt by Sun Pharma this morning. The stock is down more than 5% already, but Cipla, Dr. Reddy is also trading about 2% lower. Is this just fear selling that you're seeing, Mr. Mehta, or do you think there is something which is a real cause of concern for investors in the pharma sector right now?
I think this should look like more of a knee-jerk reaction because markets have this tendency to behave a little ahead of times. You can also say that right now, export-oriented sector, anything that has a US tag attached to it, would sort of lose its premium. Can it also trade at a little bit of discount? The answer is yes, because there is something called uncertainty. There is different thing called volatility. Right now, there is a bit of uncertainty which has come to the proceedings. So my sense is that, for example, a lot of domestic centric sectors look very interesting. Exports now, again, I know that IT exports, there is no substitute for India. As such, it can't be very negative on IT, but the sector itself is going through a lot of headwinds.
That's right.
On the US front, on the European front. But yes, specifically on pharma, I think it seems like a knee jerk, but I would also say that investors right now should probably wait for some bit of clarity and then get into sectors which are export oriented, which has a lot of its revenues tied to US.
All right, so exercise caution at an uncertain time like this. Mr. Mehta, I will come to the domestic sector also, which you spoke about. But before that, I also want to look at the energy sector, because the energy sector also seems to be a little mixed right now, given all that we are hearing on Russian oil import, EU sanctions on Indian refiners. Overall, the story for the energy sector, in fact, the week had been fairly bad for Reliance Energy as well. But Reliance seems to be okay this morning, but ONGC is down about 1.14%. Also, news trickling in that perhaps Indian refiners, as many as 4 state-owned refiners, have not purchased Russian oil for the last 1 week. My question to you, before you talk about the investor action on the energy stock, is how critical is India's oil import from Russia, and can India actually do without that discounted oil?
My sense is that oil imports are very, very important, and from why we are taking it from Russia, because it is also cheaper, it is extremely easier to access. The sense that I also get is that there will be more political rhetorics on the way, there will be political debates, there will be political gestures which will be done to sort of stop this. Very difficult to comment on this as not a political expert on this, but on the market front, on the investor side, if I can answer that question, I think it's very typically, this is a sector which is again very interdependent. Crude oil prices, if that rises in India, it has a lot of weightage on the deficit. It has a lot of weightage on input cost for a company. I think right now it is under control. Anything below 80, 85 is also a blessing in disguise. If it goes above 85, 90, and I don't think the global markets or the global economies are such strong that the crude grows above those levels. So I think it's not a bad situation for India to be in. I think India has its own very strong domestic market, and I think nobody can miss that market. That's very important for even the investors in US and the powers that be to realize that.
Right. So let us talk about the domestic consumption story, and that is the momentum that we are seeing on the Nifty 50 heat map, at least this morning, and that seems to be coming from the consumer, the FMCG stocks. In fact, HUL is up almost 4% or so in trade. Nestle is up more than 1%. Tata Consumers is up more than 1%. ITC is up about half a percentage point. There doesn't seem to be a positive trigger for this sector specifically this morning, Mr. Mehta. But is this a case that you are selling other sectors like pharma, IT, energy, and the cash is being now rechannelized into India's consumption sector?
Yeah, very, very good question. I think it was long overdue. The rally in this type of businesses, if you look at any of these companies over the last 2, 3, 4 years, most of the companies have sort of underperformed the broader market and even the indices. Now, what happens here is there's a beautiful thing called sector rotation. That comes to the fore during such times when markets are consolidating or correcting. At that time, FMCG comes across as a safe universe to be in. And because you know that there has been a good sound bites around rural consumption improving, some of the management, some of the commentaries from them were quite positive about how rural distress is now less, or they have come out of rural distress rather. RBI report also talks about rural India improving. Monsoon has been superb so far. I think you are seeing a bit of consumption where I think the bottom of the pyramid was not consuming as much. I think there is some bit of improvement. My sense that these are companies which have underperformed largely. If somebody has an objective to put up money in the safe part of the portfolio, this will be 10-15% type of compounders over a period. But more money would typically flow into discretionary consumption, which is the aspiring Indian, right? The people shifting from necessity to luxury. That is something where I think a lot of travel tourism, a lot of lifestyle expansion companies would be preferred bets rather than getting into typical FMCG companies, where again this can only be a 3-month, 6-month type of a run. But a long-term aspirational Indian consuming more should be more a story of the next 5 years.
All right, Mr. Mehta, thank you so much for your time this morning and sharing all these words of wisdom with all the investors watching this show. Pleasure having you here with us.